Something huge is brewing in the Americas. The United States is moving warships into the Caribbean. Russia is sending vessels of its own. And Venezuela, sitting on some of the world's largest oil reserves, could be the spark that sends gold and silver prices through the roof. But how? And why could this time be different? Stay tuned, because the next few minutes might change how you see the global economy. Let's look beyond the headlines. Behind every political tension lies a deeper economic motive: resources, debt, and the value of money itself. The US carries over $38 trillion in debt. Its currency dominance depends on trust and on control of global energy markets. Venezuela, with the world's largest proven oil reserves, sits right next to the US sphere of influence. Any confrontation there could shake the pillars of global finance, oil prices, inflation, and the safe haven demand for gold and silver. Empires under debt pressure often look outward for solutions. Military presence, sanctions, and strategic control of resources can buy time, but they also fuel global uncertainty. Every time the US dollar weakens or inflation expectations rise, investors turn to metals. That's why wars, or even rumors of wars, can send gold and silver soaring. Remember 2003, the Iraq invasion? Gold jumped nearly 15% that year. 2014, when Russia annexed Crimea, gold and silver both surged on fear. If Venezuela becomes the next flashpoint, the pattern could repeat on a larger scale, because this time, three superpowers are involved: the US, Russia, and China. Oil is the real trigger. Venezuela's reserves are massive, more than Saudi Arabia's. But US sanctions have crippled its production. Now imagine a sudden military standoff, blocking Caribbean trade routes. Oil shoots from $60 to $120. Shipping costs double. Inflation returns instantly. What happens next? Central banks panic and investors rush to hard assets. That's when gold wakes up, and silver follows with a vengeance. Gold reacts first and fastest. In any conflict, it's the safe haven of choice. Central banks across the world already hold record amounts of gold, shifting away from US treasuries. If the US engages in another resource-heavy conflict, expect a global rush toward gold as investors hedge against dollar volatility. Analysts estimate that a regional war in South America could add $1,000, $2,000 per ounce to gold within months. Why? Because the same governments printing money to finance war also erode faith in their currency. Gold becomes the alternative form of trust. But silver is the sleeping giant. Unlike gold, silver is both a monetary metal and an industrial one, essential for electronics, solar panels, electric vehicles, and medical tech. Supply is already tight. Global silver production barely meets annual demand. Now consider this. The world's largest silver producer is Mexico, responsible for nearly a quarter of global output. If conflict or cartel violence spreads, mining operations could slow or halt. That's when the real squeeze begins. With demand rising from green technologies and supply collapsing, silver's price could explode, potentially doubling or tripling if mining disruptions last months. Historically, silver outperforms gold in volatile times, but with bigger swings. In 2011, silver skyrocketed over 400% in less than 3 years when investors feared currency devaluation. The same psychology applies today. If inflation reappears while war threatens supply, silver becomes both scarce and desirable. Every ounce of reduced output from Mexico or Peru, every delayed shipment, can send futures markets into frenzy. And since silver's total market cap is tiny compared to gold's, it takes far less money to move the price dramatically. Let's connect the dots. US-Venezuela tension rises. Oil supply fears push prices up. Inflation expectations surge. Investors flee to gold and silver. Central banks diversify away from the dollar. Currencies weaken further, reinforcing the metals rally. That's the feedback loop of a global commodity shock. The bigger the geopolitical tension, the faster this loop spins. And unlike 20 years ago, today's social media and instant markets spread fear and speculation instantly, multiplying the effect. Behind the scenes, there's another war, the currency war. Russia and China have already been accumulating gold to back their reserves, signaling less dependence on the US dollar. If a South American conflict forces Washington to print billions more, the dollar's purchasing power drops further, and gold's role as neutral money strengthens. Think of gold as insurance against political error, and silver as leverage on that insurance. When war risk rises, stock markets tumble first. Energy and defense stocks may rally, but overall indexes slide. Investors then rebalance into tangible assets. Gold ETFs swell. Physical bullion dealers report shortages. Silver coins disappear from inventory. Premiums rise 30, 40, 50%. The pattern repeats every crisis, but this time, the supply issue could make it worse. Now imagine this perfect storm. A US carrier group clashes with Russian ships near Venezuela. Oil shoots past $120. Inflation spikes to 10%. Mexico faces political violence. Silver exports drop 30%. Within weeks, gold touches $5,000. Silver crosses 70. Mining companies can't expand fast enough. Investors rush in late, and a speculative mania begins. Sound impossible? The same dynamics happened during the 1979 oil crisis. Gold rise 800%, silver 900%. History doesn't repeat exactly, but it often rhymes. Every crisis creates both danger and opportunity. For nations, it's a test of resilience. For individuals, it's a reminder. Paper promises can vanish. Tangible assets endure. But speculation cuts both ways. Once peace talks begin or panic fades, metals often pull back sharply. Smart investors don't chase spikes. They accumulate quietly during calm periods and hold through turbulence. Remember, gold protects wealth. Silver multiplies volatility. Keep an eye on 5 key indicators. Oil prices. A sudden surge signals rising conflict risk. Venezuelan export data. Disruptions mean higher inflation worldwide. Mexican mining output. Any major strike or violence could squeeze silver. US interest rates. The lower they go, the stronger the case for metals. Central bank gold purchases. The ultimate vote of no confidence in paper money. Even without war, fundamentals point to higher gold and silver over the next decade. Supply is limited, extraction costs are rising, and new mines take years to build. Demand from technology, green energy, and emerging economies keeps expanding. Add political instability, and you get a structural bull market. Whether the trigger comes from South America or elsewhere, the message is clear. We're entering an era where hard assets rule again. Wars start with weapons, but they end with numbers, debt, inflation, and the price of trust. Gold and silver are not relics. They're barometers of confidence in our system. And that confidence is cracking. If this helped you see things differently, drop a comment and I will answer your questions. Subscribe for more honest finance content, and remember, smart money doesn't sit. It moves.